Okay, so here we have opened a 1 hour chart of the currency pair Euro USD. So 1 hour or hourly chart means each bar is representing 1 hour of the price action, and so naturally we get 24 of such bars in one day. And as a bar chart is normally expressed like with the open price, then high price of the day of the hour, sorry, and then low price of the hour, and at the end this is the close price of the hour. So if it is an up bar, it is green. If it is a down bar, it is blue here. So this is just a plain, simple, clear chart. Now let us see what volatility means. So if we put an indicator here like a simple Bollinger Band, the standard settings for a Bollinger Band is 20 periods and 2 standard deviation from its mean. It is applied to the closing price, and this is how it looks. So basically we can see that sometimes, let me condense the chart. Yeah, so sometimes the band is, these extreme two bands are getting narrowed like during this period, and then it starts expanding. So volatility works like that. It is always narrowing, low volatility, and then it suddenly bursts out or expands. So similarly here we are having narrow bands, and then it is again getting narrower. It is extremely narrow at this band, and then suddenly boom, there is a burst or breakout in the market, and the band suddenly starts expanding. So this is the particular feature of this indicator, Bollinger Band. But the Bollinger Band, this indicator is not very smoothed. The lines are fluctuating or changing frequently. So these lines, and as well as the upper band line, none of them are very smooth. So I have got another indicator very similar to this, actually a modification of this Bollinger Band, but that looks much smoother. So let me delete this one and install the other indicator called BB4. Where is it gone? Yeah, J4 Bollinger Bands. So now we can see that the lines are much smoother here, but we have got two extra lines here. There it was the center line, the mean, and just one upper band and lower band. Here we have one intermediate upper band, one intermediate lower band, one extreme lower band, and one extreme upper band, and of course the mean line, center line, which is in green. So let me further condense this chart. Yeah, something like this. Now we can see a bigger picture. So basically the concept is, if you observe this chart minutely, we can see, just if we look at these lines, extreme red at the top and extreme red at the bottom, and we can see either it is expanding up to this point, and then the bottom one is contracting, going up, the top one is still going up, and then the top one is flattening, bottom one is still going up, and here at this point the top one has slightly come down. Look at this area, the top one has slightly come down, and the bottom one was still going up. So basically exactly at this point we can see a contraction of the band. Contraction means the up one has to be downward and the down band has to be upward exactly. So that is the contraction, beginning of the contraction. So at this point, so whenever this contraction starts or happens, we can always see or expect the price to reach to this green line, which is called a mean reversion process. So mean reversion means price moves away from the mean, like from here at this point price moved up from this green line away from the mean, and after so long, after going to that distance, traveling to that distance, now it's the time to come back to the mean, and that is exactly what has happened after a few hours. Few hours means there may be 24 bars here. So whatever. Now let us wait for the next situation. So let the bar expand now. We know that once it has contracted, it will expand at some time again. So here, from this point onwards, both of the bars are going in the opposite direction, which we call expansion. So the bottom one is going in this direction, the top one is going in this direction. So expansion, the top one started contracting, started moving downwards, the bottom one is not yet, and then exactly after this point both are contracting. So this is the bar contraction phase starts, and we can see the price has already reached the mean. So the price started moving up away from the mean at this point, away from the mean line at this point, and then just when the contraction happened, price has already reached the mean. So price may reach the mean after the contraction happens, or price may be just around the mean when this contraction phase is going on. That's a very typical movement of the market. And if we go backwards and see some more instances, I think in most of the cases we can see this thing happened. So let's see here in this period. Say for example here the market, look at the extreme bands here, the top one going up, bottom one going down. So expansion phase, the contraction starts somewhere here exactly. See, from here the bottom one is going up, and exactly the top one has started falling down from here. So we can say this is the start of the contraction phase. So there is a chance of mean reversion. The price is now away from mean, so there is a chance of mean reversion. And see exactly what happened. Price has reached to the mean, just reached to the mean, and then came back downwards. So this is a phenomena we can very often observe. So let me now stop the video here, because otherwise the size is going to be too large, and start move to the next concept in the next video.